Welcome back, and welcome to the final chapter and the final series of lectures for the class. And in this lecture, what we're going to do is try to put everything that we've talked about together and into talking about the sort of final step or the final thing that we haven't covered when we're talking about analyzing a firm and valuing its cash flows. The one thing that we haven't really talked about is how the firm pays for all of this, right? So we've analyzed a project, we've analyzed the cash flows of the project, and when we did all that, we ignored or we left out any financing expenses or any discussion about whether there would be an additional cost for paying for the investment. And that's what we're going to talk about today, something called the weighted average cost of capital, or the WACC. Right? And what the cost of capital is to the firm is the cost of raising capital. And remember, capital in finance and economics, it just means money. So the firm needs to raise money or capital in order to pay for or invest in projects. And again, what we've avoided so far is the idea that it is not free to raise money. Okay? So first, when we think about that, let's think about the sort of the big picture, right? Here's the basic makeup of a firm based on the balance sheet. Remember, the balance sheet, it isn't just accounting mumbo jumbo. This actually has economic rationale behind it. On the left-hand side of the balance sheet are the firm's assets, right? They're operating assets. And the assets are all the physical things that we use to run the firm. It's our machinery and our plants and our other equipment. It's our inventory and our cash on hand to make sure that we can pay for everything. Those are all the assets of the firm. The firm is combining them and using them during its operations to produce whatever it's selling and to generate revenue. Right? Now, what the balance sheet tells us is that the right-hand side is where all of the money to buy all of those assets came from. Right? So some of the money to buy the assets was raised by issuing debt or taking out loans. Some of it might have been raised by selling shares of preferred equity, and some of it might have been raised by selling shares of common equity. And the capital structure of the firm, this right-hand side of the balance sheet, is the percentage, the relative percentage of financing that was raised from each different source of capital. Right? And so what we want to know is, partially, how did the firm pay for all these assets? And how much did it need to pay to raise capital in those from those sources, right? So it's not free to issue debt. There are a lot of costs associated with that. The main one is that you need to hire a bank to sell the bonds for you, and the bank's going to charge a fee, sometimes like 2% of the amount raised. And additionally, there's a cost associated with the debt itself, which is the interest payments on the debt. Right? So a firm that is trying to pay for an investment using a loan, using bonds that have a coupon rate of 10%, is going to have to not only pay generate enough cash flows to cover its costs, its operating costs, but it's also going to have to generate enough cash flows to pay its interest payments on the loans. Likewise, the costs associated with equity are that the equity holders typically demand dividends, and they also typically expect that the price of their equity shares rises with the value of the firm. In other words, they expect that the value of the firm is increased by taking on this investment project. And because the value's increased, their prices go up, and so they get both a dividend return and a cash price return. Okay? So there are costs associated with raising money in each of these different sources, and the firm and us are the evaluators. We have to take that into account when we are evaluating the investment projects for the firm. Okay? So what that means for us is we have to think about how to evaluate the cost of each source of capital. And we do that by using a sort of a simple trick. And the simple trick is that we know that the cost of capital to the firm is exactly the same as the return to capital for an investor. And the easiest way to think about this is to think about it in the context of debt. The cost for a firm of having a loan, of issuing bonds, is the coupon rate. It's the interest we pay on the debt. That's 10%. But for an investor that is purchasing the bond and making the loan to the company, the return of that investment is precisely the coupon rate. I buy a bond from Apple to earn the 10% return, the 10% coupon they offer. So the cost to the firm is precisely equal to the return to the investor. And that means that we can estimate the cost of capital to the firm by estimating first the expected return on these sources of capital to the investors. Now, in some cases, that's going to be really easy, like debt. In other cases, it's not quite as clear cut, like with equity. But luckily, we just had a chapter where we learned how to calculate the expected return for equity and for shares. And so we can use that. Now, what we use the cost of capital for, is to evaluate projects. The weighted average cost of capital is our required return for the firm. Right? This is the average risk for the firm. And so it's the average risk that we talk about when we evaluate projects for the firm. Okay, so the required return is our discount rate. Remember, right? Go back to chapter 9 and chapter 10. We take the present value of the discounted cash flows. Well, we discount the cash flows at the required return, the required rate of return. And this is the return that the firm must earn in order to justify all of the cost of capital. Right? So that's sort of the final step in that evaluation process that we didn't really talk about, where the required return comes from. But again, a really easy way to think about it is to think about a firm that only takes out a loan to fund an investment. So now the investment has two hurdles. The first hurdle is it's got to clear its costs, right? So it's got to cover its operating costs or we can't make any money. But then two is it has to make at least, let's say the interest rate is 10% on the loan. That project has got to make at least 10% more than its operating cost in order for us to pay the interest. Otherwise, I'm covering my costs, but I'm losing money because I'm paying my investors or the bank more in interest than I'm making. Whatever's left, that's the cash flows from assets. That's the money that I can take to the bank, right? So the firm has to cover its cost of capital and it has to cover its operating costs. And if a firm has more financing than just from debt, it has to cover its costs associated with all of the capital that it's used, right? In other words, the firm might have capital raised from debt, preferred shares, and common shares all at once. And it's using that pool of money that comes from all of these sources in order to invest in projects. Right? And so then the projects don't have to cover the cost of just one of those sources of financing. They have to cover the cost of the average of those sources of financing. And that's how we calculate the weighted average cost of capital. And that's why we calculate the weighted average cost of capital. A project must provide or compensate all of the investors that have provided us financing. Otherwise, it's not creating value for the firm. And that's what we're trying to avoid. Okay? So we will learn how to calculate the weighted average cost of capital. It is going to be the average of the costs of all of the capital sources, so equity and debt and preferred shares. And the costs to the firm are the same as the returns to the investors. So the way we'll calculate the cost of capital is we'll calculate the expected return on all of those sources of financing. Then we will weight them by the relative capital structure weight, the percentage of the capital provided to the firm by each source of financing. And then we're going to use the weighted average cost of capital as our required rate of return. This is what we will, again, finally use. This is how we calculate the required rate of return that we use to evaluate and accept or reject projects.